because of the mini banking crisis. Or just look at the last few weeks. On May 1st, SoFi reported what I thought looked a real good quarter. Clean top and bottom line beat. Raised full-year forecast. Yet, over the next 3 days, the stock lost 22% of its value. Why? Because SoFi didn't sell any of its loans that originated in the first quarter. The bears say that's because they couldn't find any buyers for the loans, which would mean that the business model is in peril. The bulls say SoFi simply didn't want to give the stuff away, and they had all the liquidity in the world. They had 37% deposit growth in the quarter, for heaven's sake. So who's right? Why don't we go by to an old friend of the show? Let's go to Anthony Noto. He's the CEO of SoFi Technologies. Get a better read of the situation. Anthony, welcome back to Mad Money.
Jim, thanks for having me.
All right, head on. Why didn't you sell those loans?
The biggest reason is the fact that we can get a better yield on those loans, a better return on those loans at about 6+% versus selling them about 4%. So they're marked on our books at approximately 4% yield. We think we can get a 6% or better yield just based on the simple math of the coupon that we have versus the life of loan losses less our cost of capital. And so that's one reason to hold the loans. The second reason is we actually have the capacity to do that. Because we have a bank license, we have a lot more funding capacity. We have $10 billion of deposits. We have $8 billion of warehouse lines, and we've only used about 40% of them as of the end of the first quarter. And then we have $3 billion of equity capital. That allows us to hold loans longer to capture that better return of 6%.
Yeah, but what happens if the loans go bad? How many are going bad? What percentage?
About 3% life annual losses, okay, relative to that 13.2% coupon. So the reality is that if we can hold the loans longer, we get that yield. It shows up in our net interest income line, right, which has grown to $200 million for the lending P&L, up from $50 million. And you'll relate to this. When it was at $50 million, that wasn't a big, visible, recurring revenue stream. Right. But at the balance sheet that we have now is generating $200 million of net income. That's recurring, visible revenue. We don't have to just rely on selling the loans.
But is the 3% loss going to 4, or is it coming back? I mean, 3 sometimes can be a hazardous level if it's going to go to 4.
In the marks that we take on our gain on sale model, the 104s, they assume a life of loan loss that's above the 3%. We're assuming for this year about 5.2% unemployment. Just a little bit over 2% negative GDP growth, and that's factored into the marks that we put on our loans that are on the balance sheet.
All right, so if that's the case, then why aren't you being valued, say, at this incredible member growth? Or does this not matter? Is this just some sort of fanciful metric that you're using? Because, I don't know, having 5.7 million members that get a lot of different privileges seems like something that American Express didn't become a great company.
It matters a ton. We've driven revenue growth of over 40%. We've had 8 consecutive quarters of record revenue. Our margins have expanded to 16% on EBITDA. Our EBITDA is now greater than a stock-based compensation, so we'll be GAAP profitable by the fourth quarter. It's driven by the members, which are growing more than 40%, the products that they take, which is also growing more than 40%, and that's what's leading to revenue growth over 40% when coupled with our tech platform that's also growing very nicely.
All right, so let's say you sold off all these loans. Would it wipe out your profitability, and it was just please who? It would please the shorts? Who the heck would it please?
I'm not sure who would please, but our responsibility is to maximize and optimize return on equity relative to our capital and our leverage ratios. We ended the quarter at a 17% our leverage ratio, that's equity to assets, that can go down to the low double digits. Because we have the capital to fund the loans, we can continue to do that, hold them, get a 6% return on assets instead of 4%. Now, what I saw in 2018 is we had rates rising.
Right.
We held our loans at that point in time. In 2019, rates started to come down a little bit. There's a lot more demand for the loans. It was actually a better ROA than holding the loans, and we sold them. I think you'll see the same thing here. We're going to hold the loans to maximize the ROA, and when rates start to come down and there's more of a bid for selling that's greater than holding, then we'll look at selling. But there's no one answer. It's like, how do you drive the best optimal return?
Okay, so when there's no one answer, I actually looked at something that is on short supply. I look at character. Now, I have known you for half my life. I have worked with you. The part that I didn't know you at, you were an Army Ranger, a West Point graduate. I have a hard time believing that the man I'm looking at, that I've done so much business with, is somehow trying to run some sort of flim-flam operation over people. So at what point can you just say, you know what? Let me show you how right I am. Or is it just going to take a long time to play out?
I think it takes a while to play out. We fought our butts off to get a bank license. That bank license is allowing us to do what we're doing right now, which is picking the choice that's the best ROA for the assets that we have and therefore the return. Many people aren't focused on this. Our bank has been GAAP profitable for 3 quarters. It delivered a 20% return on equity return already, and that's with a leverage ratio that's not optimized yet. So we're finding the right balance between holding loans and selling them, how we fund them to drive our cost of funding lower, and to make sure we're managing our risk relative to liquidity in the marketplace. And so if we just keep delivering these returns consistently and over time, it'll show itself out in the valuation.
But if you keep delivering these returns and the stock stays at 5, then why doesn't another bank buy you and just make a killing?
You'd have to ask the other banks. I think we're building something incredible that's going to be great value long term. I tell the team sometimes you have to survive a sell rating or an attack on your company. And once you do and you come out the other side, people understand the company better, your results are rewarded better, and the value is eventually seen. So as tough as it's been a great period for us to educate investors and build a great, stable understanding of what we're doing and how we're doing.
And it's not like all this chatter or these sell downgrades or anything, the $7 billion. Here, I got one right here. It says you need equity. You got to raise equity right now in order to be able to meet what the regulators would say. True?
That's untrue. We have a 17% equity to asset ratio, which is our leverage ratio. That can go down to the low teens. So we have the capital to fund the loans, and we have capacity in our bank holding company leverage ratio. Those are the two things that would indicate when we need to raise capital. And I think the other important point in all of this is, as you think about the revenue streams of the company, are those revenue streams sustainable? Are they durable? And are they visible? And having net interest income in this environment is incredibly valuable to us. That means we don't have to start at zero every quarter. And that, as I said, is at $200 million up from about $50 million a year ago.
Well, there you go. I mean, I think that the people who've been trying to get me to say bad things about you, I tell you, they're not going to have good luck. Well, I look at it.
Well, I appreciate it, John.
All right, absolutely. That's Anthony Noto. He's the CEO of Sofi Technologies. And yes, a longtime friend. And you can say, oh, Kramer, you're in the bag, Anthony. I tell you, you know what? Never. Neither one of us ever do like that. Everybody's back at the
Wow. All right, guys, that is a wrap on the interview. And it looks like, Jim Cramer, what he said is a lot of people have been wanting me to talk bad about you, Anthony Noto, but from what you're telling me, it's not true. So Anthony Noto basically said that, when they said SoFi needed equity, that's not true. They're coming out to make the company look, bad when it's really not. So he covered a lot of things about these loans. They got to hold them right now to maximize returns for investors. And that was the thing that Jim Cramer started with. And Anthony Noto once again mentioned profitability by Q4. And it just looks like, the same things are continuing to be spread again by Anthony Noto. I mean, this is what we're looking for. We want them to maximize returns. We want them to be profitable. We want them to continue this 40% growth, year over year. That's what we want to see. Student loans didn't really get brought up in the announcement or the interview. I don't know. It just looks like Cramer had some negative things he wanted to be brought up. He disclosed all of the negative bear arguments, and Anthony Noto answered all of them exactly what we're trying to do, and we got to continue to do it. So pretty good interview. And if you enjoyed this video, be sure to smash the like button. Let's try and get the video over 1,000 likes. Don't forget to drop a comment what you think about the interview, and don't forget to subscribe to the channel.